Markets are continuing to reflect the thawing of the icy conditions that were really holding on to a lot of the government debt markets and the banking industry during the course of the latter part of 2011. As we've discussed before, the two-stage LTRO programme that has now pumped over €1 trillion into the European banking system, effectively building a firewall under the system, has certainly now allowed many risk assets to start to trade higher during the course of 2012, and this is a trend that looks increasingly set to continue. There is a wall of liquidity which is in the financial system at the moment, and risk assets are very much back on the agenda. And we are seeing some changes also in some of what I refer to as very much the safe haven government markets. Do remember that when risk appetite was significantly reduced, a lot of money hid in the safe havens of US Treasuries, German bonds, and indeed even UK gilts. But I want to start off with two charts which just reflect how those assets are starting to sell off and yields are beginning to climb in some of those fixed income markets. Here we start with the UK gilt yield. And remember, this is an inverse relationship to the price of the gilt. So as the gilt price falls, the yield rises. And this reflects, as you can see here, this yield from going back just 12 months ago, where the yield was at maybe 3.6%, hit a low of sub 2% in the early part of 2012. But look at this spike towards the latter week, with yields now up at 2.4% at the moment in the UK. And the same is pretty much true of the US. Again, we can see this spike in 10-year government yields, the yields now moving into the 2.3% region, having hit those all-time lows at the end of January. Now, this is something that you can read in a number of ways. It does mean that I suspect that money is heading out of those safe havens and back into some of the riskier asset classes at the moment. It is also increasingly of the view, I suspect, that these central governments need less financial assistance through QE programs, and indeed that the economies are beginning to revive. And as we start to talk about good retail sales, good industrial confidence, and indeed for healthier looking conditions, then there's one thing that will be next to go on the agenda, and that is, when do central banks start to ease off this assistance program? When will they have to start thinking about pushing interest rates up? At this juncture, it still is 2014 at the earliest for the US, pretty much the same for the UK. But yields in the 10-year market, as I've just shown for the US and UK, are starting to trend higher here at the moment. So some interesting signs. So what is that meaning for other things? Well, there's one asset class that I think is worth looking at for 2012 as to where the action is beginning to happen, and that is the financial sector. So this is one sector not often looked at, but this is a one-year chart of three companies that operate in the assurance sector. We have Aviva, Pru, and Legal & General, and these stocks have all been performing very strongly in 2012. We've seen gains of around 30% in Legal & General and the Prudential, slightly smaller in the case of Aviva, but nevertheless this is a sector that is very much moving significantly ahead of market returns at the moment. The same is true of the banks. Again, this chart here reflects the sort of strong bounce that's been seen in the banking shares. Here, returns year to date have been up around 40%. Clearly, this sector is coming off a much lower base at the moment. But what I want to sort of try and get across here is that the big rally that we're seeing equities at the moment is very much being charged by the financial sector. It's not being charged by industrials at this stage. I suspect that one has to wait to see how much of this €1 trillion that is building firewalls in the banking sector can find its way into the real economy, and one's sceptical about how much will find its way in that direction. But nevertheless, it is the financials that are driving investment returns at the moment. I suspect many investors are still underweight that sector at the moment, given the battering that it's had over the course of the last couple of years. Now, where that €1 trillion is clearly heading remains into the government debt markets, and particularly those markets that need assistance. And we've continued to see both the Spanish and Italian yields continue to reduce over the course of this year. This chart is interesting, though, to show that Italy was the main cause of concern, this purple line going back into the earlier part of this year. But really the actions that Italy have taken taken has meant that their yields have now crossed over with Spain, and that actually it's Spain that is possibly more of the worry. We have heard from this week that Spain's deficit for 2011 was much higher than expected, and there's been a little bit of a tussle between Euro finance ministers and the Spanish ministers about their forecast for 2012 and indeed for 2013. It looks like they've given them some leeway for 2012, but they've been very tough with them on trying to achieve a deficit of just 3% for 2013, a number that I think could be quite a challenge to meet. If we look finally at the FTSE 100 index, this chart is a 10-year chart, so it takes a stronger look or a longer look back at where we've come from over that 10-year period. And I think just really what one's reflecting is the way that this market is continuing to build lower highs now. So each time we do have one of these pullbacks in the market, it's coming back less than the previous sort of low, and we're now beginning to challenge these upper regions. This is coinciding with obviously 6,000 on the FTSE 100 index, but there's a real sense of opinion out there that this is a market that is much better at embracing bad news now and absorbing it and beginning to respond to the good news, which is undoubtedly coming out from some of the data that is just beginning to show that the recovery has got some longevity to it.